let's get to our guests. We've got Tom Lee, Chief U.S. Equity Strategist at JPMorgan Chase. I want to get his thoughts on some of the issues Matt's been bringing up. Tom, by the way, has the highest target for the S&P 500 among the Wall Street strategists that we survey. Tom, great to have you back with Matt and myself. You are the most bullish out there. I mean, I'm looking at what you're expecting for the S&P by the end of the year, 1475. That means up almost 30% from where we are today. Tom, how do we get there?
Yeah, well, it's happened before. I mean, I think that the analogy I have is that this is either 2008 or 1998, where you've got a crisis really developing, and, we are kind of, at the mercy of policymakers. But the reason I think that this is not '08 is, we're really entering this period of sort of rising sort of financial stress at a time when underlying health is actually quite good, for businesses. Even economic data, I think, has actually been pretty supportive. I think if you don't trust the claims data, look at the rail data. The rail data we got today shows total volumes is the highest ever all year. So, I mean, the economy, even into September, the third week, is still expanding. But, we do need a decisive break, and I think we're starting to get some progress in Europe. I wouldn't be as optimistic to say that we're at the end game, but I do think that they understand how serious the problem is there. And, in the U.S., policymakers really have a chance to do something right with the super committee. And again, they're going to operate in secret there. But I do think it's important for the public to put a lot of pressure on Congress to really make sure they come up with a big deal.
Hey, Tom, yesterday we had Doug Cliggott on. He's very bearish, looking for $81 S&P earnings next year, when I think consensus is closer to 110. But his point, and I asked him why he's always so bearish and we keep getting bigger earnings gains than he expects. His point was that it was because of the incredible stimulus that we've seen. But as that comes to an end, he really sees us falling off the cliff. I'm sure that you get his point, right? And don't we seem like we're coming to an end? If the president finds it hard to put through $400 billion after doing trillions, are we going to have tough times putting out the big numbers?
I mean, those are definitely big numbers. I mean, it's the S&P earnings aren't just up because of stimulus. Otherwise, we would be able to really track that. I think that there's been a lot of growth in S&P earnings and profits because of global expansion. The global economy has already surpassed by, I think, 4 or 5% its 2007 high. I mean, so it's not a surprise that S&P earnings are higher. I mean, the global economy actually has grown since the last earnings peak, and U.S. earnings, or U.S. GDP, has only just sort of reached its old high. So I do think U.S. is trailing, but it's not just U.S. stimulus that's been driving S&P profits.
Hey, guys, we're talking profits, so I want to bring Sheila into this, because, Sheila, you're looking at the earnings picture, and it's been coming down, hasn't it?
Yeah, I mean, look, corporate profits, they've always been this kind of bright, shining light in this picture and in the recovery here, but now you are starting to see cracks in that. So SocGen actually recently put out a report saying that for overall 2012, global earnings figures have been getting cut by about 3%. Not a surprise, a big portion of that came from Europe. In fact, estimates there down 6.6%. U.S. cuts have been relatively mild so far. And Tom Lee, I know one of the reasons you are so bullish about stocks is because you take a look at the PE multiples and they're so cheap. My question to you is, with European estimates coming down, overall global estimates coming down, isn't it just a matter of time before U.S. estimates come down as well? I mean, all these global companies, they sell into Europe. Europe buys from the U.S. I mean, we're so interconnected now. Isn't it just a matter of time?
I mean, I think that we're on a path. If nothing happens, and if the crisis keeps spreading, I think we are on a path for a global recession. But, that's kind of like saying where someone took their hand off the steering wheel and no one's trying to grab it. And so, one, I don't think we're necessarily destined for sort of this global contraction, but we're on a path. Unfortunately, we are on a path towards that. And with regard to earnings, S&P profits are going to be sensitive to variability in GDP out of Europe. We're at 105 for earnings in 2012. That's a 2% GDP growth. But the swing factor that's probably more important there is really emerging markets, also Latin America and Canada. I mean, those are much bigger trade partners and GDP swings for us rather than European activity.
Hey, Tom, I want to roll into this. Bloomberg did a global poll of investors, and we've been kind of parsing out the data throughout the day, looking at what they think about the global economy. They also, in terms of what they think about the market outlook, this is an exclusive poll of global investors, more than 50% said they think U.S. equities have entered a bear market. So And also 17 have said that the U.S. Equities entered a bear market. Okay. So, I mean, more than 50% said that they think U.S. equities have entered a bear market. Forgive me as I try to read my notes here. But, I mean, so there's an extreme, I don't have to tell you about it, there's an extreme feeling of bearishness out there. Does that say to you that when the sentiment gets so low that maybe we are hitting a bottom? Or does it say to you that, yeah, folks are worried and it's going to be a long time before they put some money to work here?
Well, you know, unfortunately, we won't know the answer for that for at least another 6 to 8 months. You know, investors being bearish is generally a pretty good thing as long as there's perception errors that you can identify, or if we're sort of starting from a reference point of great pessimism. And I think you can make a case that maybe both are taking place. You know, I think investors are still very, very shell-shocked from '08, so they're very prone to sort of, because of pattern recognition, think we're sort of entering back into the '08 period. And I think that's been a pretty common paraphrase I've been hearing. And with regard to the underlying data, I do think there's a misperception in terms of the underlying strength of the U.S. economy. It's not just stimulus here or, you know, QE that's been sort of driving this economy. I think that there's been true underlying recovery demand. We're seeing it in sort of the housing data stabilizing and improving home prices, the rail volumes picking up.
Tom, you really feel that way, especially with housing data? We talked to Bob Schiller this week. I mean, there are folks out there that still don't think we've bottomed out here. The housing market doesn't feel like it's gotten really that much better.
Yeah, I'm sorry, I didn't hear. Did Bob say he thinks house prices are? I didn't hear what you said.
You know, he's still concerned that maybe we're not here at a bottom yet, and so are others.
Yeah, I think with housing, I think the market's become very. You've started to see a bifurcation between distressed and non-distressed housing. You know, 4 months now of seasonally adjusted home prices going up. Whether you're looking at FHFA, Radar Logic, Schiller, they're all pointing to home prices really starting to stabilize here. I do think one of the big obstacles or what's really gumming up the machinery is really the lack of credit flow to consumers. You know, I think lending standards are high, and from what we can sort of really assess from the situation, it really looks like it's very tough for banks to feel comfortable lending given all the litigation and the pressure they're getting from government. So, I mean, in some ways, I think policymakers are really hurting the housing market.
Tom, let me ask, when you put your target, or when you think of your target now, as opposed to when you put it together, is it a best case scenario and worst case scenario, and this is the middle, or is it like everything has to go exactly perfectly for us to make 1475? I mean, I kind of imagine a guy holding like horse track betting stubs and thinking like, please, please, please. You know what I mean? It seems tough.
Yeah. Well, Matt, I think that's true. I mean, I think that like the sort of, if you had to map this out, I think we're really facing some pretty big outcomes right now because, you know, if you look at the non-material tail risk of, you know, a bank failure in Europe and then the effect it would have on the global financial system, you know, it's a substantial risk. But on the other hand, you know, if we can sort of stabilize the crisis there, and we see sort of policymakers start to ease in emerging markets, and of course the U.S. sort of powers through this sort of soft patch, you know, and I do think there's some evidence that some of the weakness is still just the lingering effects from the quake.
You know,
I just wonder why you don't change it more often, because we have other bulls like Barry Knapp or Jonathan Golub who are constantly revising it closer and closer to sort of reality, but you don't seem to move it.
You know, I think it's just a matter of sort of what we're sort of trying to express from our views, because, you know, on the one hand, one of the constraints of a target price is it's a single point, and I think that, you know, the reality is like if this is shaping up to be 98. Yeah. It's the single point's actually a pretty big upside move. So I think that's the challenge.
All right, Tom, we got to run. Tom Lee, JPMorgan, thank you.